wondering if you could talk about how you would analyze a price target like that using this framework.
I think markets are not divorced from macroeconomic reality. That's, of course, any price could be divergent from macroeconomic reality for periods of time. We've certainly seen plenty of that in our careers. But part of what ends up happening, what ends up eventually driving asset prices is the macroeconomic reality. For instance, let's not forget, there was like 7 cuts priced in for the U.S. for 2024, only 6.5 months ago, right? But what policy actually transpired ended up being, isn't divorced from the macroeconomic reality that occurred, right? That's the corollary. And so the same is true for companies and stock prices. Of course, there's bubbles, there's busts, there can be divergences, but ultimately, stock markets are made up companies. Companies generate cash flows. They generate earnings. Those earnings are purchased on certain multiples. And so you can start to think about what are the ranges, and those earnings are a function of sales. Those function of sales is a function of economic expansion and whether they can pick up market share in the economy. And so you can start to think about, what are reasonable expectations in terms of what you'd expect. So take a very simple example, leave the 15,000 aside. It's like 5.5 years from now, who knows? But just take for a simple example, like today, S&P 500 earnings are expected to be 17% year over year by the end of the fourth quarter. Okay, so very simply, how do you get to 17% year over year earnings growth in the S&P 500? Well, you have to have some combination of margins and revenues that get you to 17% growth. If you think of the S&P 500 companies as being a broadly diversified basket of companies that are reflective of, the broad economy, well, if nominal growth in the U.S. economy is, let's say, 5 to 6%, just to be, that would be pretty good, actually, 5 to 6% over the course of 2024. If that's the case, that's what nominal growth looks like. Sorry for the lighting thing. Then if that's the case, then the way you get to 17% is you have to have, margin expansion, right? Margins are already expected, are already at secular highs. How do you get even more margin expansion from where we are today, right? To make up for the, to get another 12% earnings growth. Well, you have to have margins go up, a point and a half. Okay. Well, what are margins? Margins are just the difference between sales and what the sales cost you. And what's the biggest cost? Labor. Okay, but there's an intersection between those 2 points, which is a very important point, which is if you pay labor less, then they spend less, right? Those 2 things are linked to each other. That people often forget this. This comes up a lot, like with the AI story. They're like, AI is going to create a productivity boom and companies are going to be able to fire a lot of people. Okay, if you fire people, then they have less money to spend, right? Those 2 things are related to each other, right? This is why you can't have a stock market. Revenues are not disconnected from wage growth because people need money to spend. And so if you think about that interplay, how do you get the margins? Well, the only way you get margin expansion is if there's savings, because it's only through the process of savings that one can spend more than their income. And so that's how that interplay works. So let's get to that 17% number. Well, if you take 5 to 6% nominal growth, 5% nominal growth, let's just say, because the economy is slowing, then I still need 12% to happen with margin expansion. Okay, are households going to borrow more? Are businesses going to do more CapEx and borrow more? Is the government deficit going to widen considerably? Like, who is going to do what to lead to that expansion? It's not disconnected from reality. It has to exist in the context of the macroeconomy. So I think that's such an important thing. And it's the thing, if you went through the 2000 cycle and you heard all sorts of stories, new economy, companies are disconnected. Nope. The 2000 cycle worked exactly the same way. which is that, ultimately earnings were not disconnected from the real economy, and the real economy has limitations. So that's kind of the interplay between all of those different pieces. And you could think about that on a 1-year time frame or on a 5.5-year time frame.